And welcome to Retirement Revolution. My name is Cynthia DeFazio. I'm joined today by Randy Locklier, and Randy is president and founder of Gulf Financial Group. Randy, how are you today?
Fantastic. I hope you're well. It's good to be with you again.
I am fantastic as well, and I'm so excited to see you again because I know you've been so busy. Let's talk about how the shows have been going for you, and what about the consultations you've been booking in the office?
It's really been terrific. We've had a lot of people to give us a call and set an appointment where they can come into our office, and we're able to sit down, and usually in a half hour or an hour or so we can get a good feel for their financial situation, and in most cases we're able to help them generate a better plan, either with less fees or more growth, and so it's been terrific.
That is wonderful. Let me ask you, Randy, why do so many people going into retirement not have a plan in place?
Well, you know, only about 10% of people that are heading into retirement actually take the time to sit down and make a plan. You know, we're living a lot longer these days, and so if we retire at 65, a plan to age 95 is probably reasonable, yes.
Sure.
But most people don't do that, and we find out that that's oftentimes the case, or they might have a plan that they put together a long time ago that they haven't updated with new strategies and new information that's on the market today. So certainly we think the plan is a crucial part of success in retirement, and if you don't have one, or if you have an older plan, or maybe your plan is not working, give us a call. We can sit down and take a look at your situation and probably make some improvements.
Oh, that's wonderful. That's a great thing to know, Randy. Absolutely. Let's talk about next generation investment strategies. You're passionate about that. Let's talk about it this morning.
Yes, indeed. So the way most people invest today, right? You can look at just about anybody's portfolio. You're going to find one of two things. You're going to find mutual funds, and you're also going to find ETFs. Most people in their retirement plans just have a selection of different funds that were recommended either by their advisor, or in some cases, they're the selections that they have with their 401k provider. You know, they can go select a couple of different strategies within that. So we find that the vast majority of people are in what we call passive investments. A mutual fund is a passive investment. We don't have a advisor that's actually managing those assets on a daily basis, okay? So we set it like and forget it. You know, we've heard, what was the old, you know, the oven show, right? We set it and forget it, and my turkey is done at the end. Well, retirement really doesn't work like that, right? So we want to make sure that we have a actively managed plan. So, but we find that most people don't. Most people just have a selection of mutual funds, and whether that's the right thing or not, it's not always the right thing.
Absolutely. Let's talk a little bit about, a lot of people, like you mentioned, Randy, they don't even know what they have in their portfolio. Like, they sat with someone and they were just like, okay, this is going to be a good product for you, here you go. Why is that a bad thing? Let's talk about that. Well,
sure, it can be a very bad thing, because you might be getting what we call a boilerplate or cookie cutter solution, an off-the-shelf scenario, okay? So we find very frequently, let's say I'm 65 and I have a risk tolerance of 5 on a 10 scale. I get a proposal from one of the big box shops. I get an investment portfolio. Pretty much, if I'm that same risk tolerance and age, anywhere in the country, I'm going to get the same exact portfolio that everybody else gets. I can tell you that I worked at one of these places for a number of years. I managed an office for a discount broker down in South Carolina. And all we did was plug people into the company-sponsored mutual fund portfolios, period. We weren't able to make any investment decisions outside of that. In some cases, these were not, you know, appropriate for these people, but we didn't have alternative investing options like annuities or structured notes or dividend-paying stock portfolios. Off-the-shelf, cookie-cutter mutual fund portfolio, and it might not be right for your retirement. And if that's what you have, we should take a look at it and look at making some changes to improve our performance, reduce our fees.
That makes sense. Can I talk to you about the balance of cash, stocks, and bonds in a portfolio?
Okay, so investing 101. I like to think it's not as difficult as some people think it is. We really only have 3 asset classes that are available to us to invest in. We have stocks, we have bonds, and we have cash. Those are the asset classes. Now, a mutual fund, it can be a stock mutual fund, bond mutual fund, a blended mutual fund, but all of the investments out there are made up of those three categories.
Okay.
Now, modern portfolio theory is the basis of most people's investing strategies today. This was developed by an economist, Harry Markowitz, back in 1952. 1952, okay?
Wow.
Now, have things changed since 1952?
Maybe just a little.
Just a little bit, right? Yeah. And so maybe the old way of doing things is not the best way. But basically what modern portfolio says is I want a mix of these different asset classes, and I want to be diversified within those asset classes. And it's powerful in helping to reduce risk, okay? So I can certainly reduce what we call unsystematic risk if I use modern portfolio theory. You know, it's the old, don't put all my eggs in one basket.
Exactly.
We've all heard that, right? We have different baskets. We're going to minimize the damage to our portfolio if we drop one of the baskets. We still have the other baskets, right?
Absolutely.
So modern portfolio theory does work well to help protect you from maybe an individual stock in your portfolio going south. What it does not do, though, is protect you from what we call systematic risk. Systematic risk is interest rates go up, recession hits, stock market falls, we can have a war of some kind of political upheaval in the country that causes the markets to be volatile. Okay, these things, modern portfolio theory does not do a good job of protecting against those risks. So what we find instead, that there are better ways, new generation ways of investing today where we can elevate our return and reduce our risk. Think about doing it a little bit different than we did it in 1952.
Absolutely, that makes perfect sense. Well, Randy, this is the perfect time for us to open up the phone lines to the viewers at home. Would you agree?
I agree.
To the viewers at home, the phone number to call is on your screen. That number is 833-403-4041. What Randy is offering you today is a complimentary consultation. Let him take a look at what your hopes and dreams are for retirement. Do you have the right plan in place, or do you need to have a plan that's designed from scratch? Randy can help you with that today. And again, there's only 10 spots available, so don't miss this opportunity to call in and gain one of those complimentary consultations. 833-403-4041. We have to take a very short commercial break, but when we come back, we're going to have so much more, so please stay tuned.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have, by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
And welcome back to Retirement Revolution. My name is Cynthia DeFazio, and I'm joined today by Randall Locklier, and Randall is the president and founder of Gulf Financial Group. Randall, a great show we're having today, and again, I love watching the phone lines light up when we go to the commercial break because people really want to gain that complimentary consultation with you. So let's talk a little bit about if someone is in the audience right now and maybe they're working with one of the big box brokers. What can go wrong with that?
Well, you know, I mean, I remember when I was a kid, you know, when the TV show would come on and there was adult content, not that kind of adult content, right, but different shows, and they would say, get the kids out of the room because we might be dealing with more complex topics on the show, right? So if you're a banker or if you're a big box investment advisor, you might want to turn your TV down or maybe step out of the room, because I'm going to bust a few myths about choosing the bank or the big box advisor to do your retirement planning. So if you are, you might want to step out. You might not hear a couple of good things about your profession here, but yeah, so certainly what we want to do is kind of revolutionize retirement, right? A next generation strategy that's different from what you're going to get if you show up at the bank or you show up at one of the big box investment shops. Okay, what you're going to get in that scenario is mutual fund portfolios, maybe ETF portfolios that are going to be put together in a model that everybody across the country is going to receive that same kind of investment if they're in your situation. This is not always best for the individual retirees, okay? We find in many cases that we can improve the return, we can limit risk, we can also reduce fees if we use, instead of just a bunch of mutual funds, alternative products that we can reduce the risk in the portfolio, and we can also improve performance for the client.
Okay, excellent. And I love that, because a lot of times people are in the viewing audience and they're wondering exactly if they're with the right advisor. Can we talk a little bit about why it's important to work with a fiduciary, Randy?
Well, I think it's important to deal with a fiduciary. So fiduciary basically means trust.
Yeah.
Okay, a registered investment advisor, which at Gulf Financial we're a registered investment advisory, and we are fiduciaries. What that is as a registered investment advisor, we're required to act in the best interest of our clients at all times.
Okay.
We can't make decisions that are best for us. We have to make decisions that are best for the client. So what that means is that high commission structured investment products, we're not offering those to our clients. Things that may be better for me but not better for the client, that's not what we're doing. What we want to do is look at the client's money as if it was our money, you know, or a family member. Are we making the decisions that are going to help that client to achieve their goals?
Okay.
And now, as a client, you have recourse. If you're dealing with a fiduciary and you get bad advice, you can certainly have a regulatory action or a lawsuit. Now, we've never had either, of course, here at Gulf Financial, but dealing with a fiduciary is going to give you an extra level of confidence that you have somebody that's in your corner in retirement.
Okay, thank you, Randall. Thank you so much. Let's talk a little bit about what are the downsides to passive investing, the downsides, if you will.
Well, passive investing means just that. It's passive, okay? I set a portfolio, and I really don't have a manager that's taking a look at my portfolio, usually on a daily basis, right? That I can make decisions. I can seek opportunity to invest in different things. I can protect myself against risk. I'll give you a brief example. Now, we don't believe that we should trade in and out of the market all the time, but certainly we have what we call a stop-loss algorithms that are built into some of our investment portfolios.
Okay.
So that is a system that we can put in place where if we have a market drop, a one-day drop that exceeds, let's say, 5%, we have the ability to move our clients into cash in that scenario. I know that there have been several times back in the COVID crash days where we had a one-day drop in that 10% range. Well, most of our clients were protected there because when it hit 5%, we moved to cash and then we reinvested. That's active investing.
Sure.
Management, okay, where I'm looking at the portfolios on a daily basis so that we can take action to reduce risk or to seek additional opportunity.
Okay, absolutely. And that's a blessing to your clients because they want to have someone that's taking a look every day just to see what's going on. Then you avoid the surprises when you wake up in the morning, like, right?
What happened to my money?
Exactly. There you go. Let me ask you, is there any risk with government bonds, Randy?
Well, it used to be that it was very safe. A government bond was very safe. A treasury bond, you know, you can buy them in different lengths. We don't think that the government, U.S. government, is going to default on the bond payments, okay? And historically, they've made the interest payments. They're supported by our tax revenues, right? But we have a lot of risk in that particular market. We have the fact that the interest rates are extremely low, right? So certainly we're going to lose purchasing power. The 10-year Treasury is paying under 1%. 1% is not a very good return. And even if you go to 30 years, you're not getting much more return than that. So bonds, especially government bonds, do have significant risk associated with them. Now, if you have bonds that are in a mutual fund portfolio, the risk is heightened in that situation even more, because we don't have an individual bond. What we have is a selection of bonds that are grouped together, all with different durations and maturity dates. And I remember learning in business school, and it's certainly been the case, that bond mutual funds are much more susceptible to interest rate fluctuations than an individual bond would be. So if you're holding bonds, even government bonds, in your portfolio, we'd like to talk to you, because we think there's some better ways to do that.
Okay. Randy, let's talk a little bit about where the interest rates are today.
Well, interest rates are at an all-time low.
Okay.
So one thing about next generation investing is we have to deal with the current landscape that we have. Okay. You remember we talked about modern portfolio theory and allocating to bonds?
Sure.
Well, back in 1952, 62, the bond rates were much higher, 5, 6, 8%. So it made sense to have a lot of bonds in your portfolio because they were generating good income. That's not the situation that we have in today's market. In today's market, we have bonds that pay close to zero in a lot of cases, right?
Sure.
Certainly the banks and the credit unions, they're about close to zero on interest rates there too. So we have a completely different landscape, and that requires a new approach. It's not your father's retirement. The old way of doing it doesn't really work anymore, not in a low interest rate environment. So we recommend strongly, let's look at the bond portion of the portfolios in our clients' retirement plans to see if we can improve return and reduce risk across that asset class.
Absolutely. Let's talk a little bit about people that are in the viewing audience today, Randy, and perhaps they are 5 years away from retirement. Is it too late for them to start working with someone like you?
No, you know, at any point that you are already retired or getting ready to retire, that's the time to sit down with a financial advisor and put the plan together, because what we usually find is that the process of doing the planning is going to uncover certain situations that might exist in your retirement. Maybe I have an income gap. Maybe I'm taking too much risk. Maybe I don't have enough return in order to meet my retirement goals. So any of these things are going to be uncovered during a plan. The very process of it is going to allow us to create a robust retirement plan for people. So it's never too late to start. And we would recommend that if you haven't started, let's get saving money and let's get a meeting together so that we can help you get rolling.
Well, Randall, this is the perfect time for us to reopen up the phone lines. Would you agree?
I agree.
To the viewers at home, the phone number to call is on your screen. That number is 833-403-4041. What Randall is offering you today is a complimentary consultation. Let him take a look at what you currently have in place for retirement. Is it the right plan? Does it need to be tweaked or adjusted, or perhaps designed from scratch? Again, we started the show today with 10 spots being available. Right now, there's only 4 spots remaining, so please don't miss the final 4 spots this week. All you have to do is pick up the phone and call 833-403-4041. We'll be right back after this very short commercial break.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to Retirement Revolution. My name is Cynthia 𝗵𝘃, and I'm joined today by Randy Locklier. He's president and founder of Gulf Financial Group. Randy, a great show that we're having today, and obviously I love watching the phone lines light up, and it's just so exciting for me to see because people definitely want to have that opportunity to come in and sit with you. We also have some viewer questions, so I'd love to spend a little bit of time with the remainder that we have in the show just answering those, if that would be okay.
We've got some great questions, I'm sure.
We do. So are you ready?
Yes.
We have Dwayne in Panama City Beach. He said, I have a 401k, will be retiring soon, and I'm worried about having enough income for retirement. Social Security will not be enough. What can I do to solve this problem, Randy?
That's a great question, Dwayne. And you know, many people are going to face this. Social Security often is not enough in order to meet all of our spending requirements after we retire. We talked a little bit on a previous show about pensions in America and the fact that they really don't exist anymore. And the problem that the viewer is expressing there is, I have a bucket of money in my 401k, but I need to turn it into some kind of income stream. And how can I do that? And there are a number of different strategies, but certainly we would consider in this situation maybe using an income annuity to create a lifetime income stream for the viewer and even his spouse even, okay? So we can create a lifetime income stream that we can add to our Social Security, and at that point we have a situation in which our monthly checks are enough that we can meet our living expenses and continue to pay our bills.
Thank you, Randall. Excellent answer. This is another great question. It says, Randy, recently I heard the term dollar cost averaging used in the news. As an investor, how do I utilize that strategy, and what are the benefits associated with it? Caller from Panama City.
This is one of the most fantastic tools of growing wealth long-term, is dollar cost averaging. What it means is that I'm going to buy an equal dollar amount of some kind of securities. It might be mutual fund. It could be a part of my payroll deduction each paycheck period. But I'm taking a set amount of money and I'm buying securities each month. The math works out this way, okay? If you do it for long enough, you can virtually assure that you have a situation in which you can't lose the money in your portfolio. In other words, my average cost is generally going to be less than what my average sale price is. So over time, if I dollar cost average, it's a very powerful way to build wealth. Now, we can also do it reversely, right? A dollar cost average out of our positions when we reach the preservation and distribution phase in retirement. So if you'd like to learn more about how you can use dollar cost averaging to improve your returns or mitigate your risk during that withdrawal phase, give us a call.
I agree. This is a great question too, Randy. It says, how do I get the most money from Social Security? Should I take it early?
Well, that's a tough question. You know, when we can take Social Security at 62, obviously we're younger at 62 than we are at 72, and maybe money is better when we're younger to spend it. Okay. So this is kind of a question that we want to look individually at the client's situation to see what is best to do. Now, if you wait until 72 to take your Social Security, your paycheck is going to be about 34% higher than it would be if you started at 62. As a matter of fact, each year that you defer taking your Social Security payment, your increase is going to be in that 8% range. So if you don't need to take it, it's best to wait and let it grow a little bit, right? One of the big mistakes people make is starting it too early. Okay. And then realizing it's not enough down the road. But this is a very individualized strategy. We actually have a program that we use that's called Maximizing Social Security. We're going to be able to look at your situation, plug the numbers in, and work with you to help make the decision about when is the best time to turn on that income flow.
Okay, thank you. Excellent advice, Randy. Thank you so much. This is a great question. It says, Randy, is the bank a good place to go for retirement planning and investments?
Are there still any bankers in the room? I suggest that you step out, right? Well, maybe not, okay? Now, the bank is a good place to keep money, and they do some things very well. But when it comes to investing, it might not be the best place. Number one, I'm going to be extremely limited in the options that are available for me at the bank. We say that's a captive situation in which your advisor at the bank, he can only offer you the bank-approved products. Whatever has the stamp of the bank on it, that's what you're going to see. It might not be the best. Certainly, we found when working with banks that the selection of annuities that they offer pales in comparison to what's really out there. So if you want the best investment products and the highest level advice, you're probably not going to get it at the bank. We would suggest that if you are dealing with a bank or a credit union, you might want to seek a second opinion on your plan, on your asset mix, and we'd be glad to take a look at it and maybe show you some different, better ways of managing your retirement assets.
Okay, excellent. Thank you, Randy. This is a great question, too. It says, Randy, I really enjoy your show, but what's different about Gulf Financial?
Well, it's a radically different approach. That's why the show's called Retirement Revolution. We're here to bust the myth of the old way of doing things. So when you come into Gulf Financial, first off, it's going to be honest, forthright advice. We're going to have a relationship-based client service experience for you. We want to get to know who you are. We're going to do a lot of listening. We're going to build detailed plans that involve every aspect of your financial life. It's much, much different than what you're going to get at a big box shop or the bank, where they're going to throw a portfolio at you and say, good luck. That is not retirement planning. What retirement planning is we look at all of the income streams, all of the assets that are available, and we create a permanent income plan. We're concerned about things like wealth transfer. Do you need a revocable living trust? Do you have children that you want to leave? Do you have a special needs requirement? Do you need a trust? Okay, we're going to really get into in-depth solutions that you're not going to hear if you walk into the bank or the big box investment shop.
So personalized attention and a customized design plan for that person. Thank you for another amazing show this week, Randy. To the viewers at home, once again, the phone lines are now open. That number to call is 833-403-4041. What Randy is offering you is the complimentary consultation. Let him take a look at what you currently have in place. We look forward to seeing you back again next week. Be safe, be happy, be blessed. We'll see you soon.
Thanks for watching.